Welcome back to the Deep Dive.
Great to be here.
Today, we're getting into the Rockwool Q1 2025 earnings call. We've gone through the details, pulled out what we think really matters for you, the experienced investor.
Yeah, it's quite a picture. Shows a company, dealing with some market challenges, but also making some pretty big bets on where things are headed.
Definitely. Our goal here is just to unpack the call, help you see the underlying dynamics.
Exactly. Beyond the headlines.
Okay, so let's jump right in. The snapshot for Q1.
Sure. Revenue came in at 959 million euro.
And that was up 4% year over year. Importantly, that held for both local currency and reported figures, right?
Correct. 4% across the board there. And profitability looked pretty solid, too. EBIT landed at 154 million euro.
Which gives them that 16% EBIT margin. Strong number.
Very strong. Now, cash flow. Free cash flow was negative for the quarter.
Okay, how much?
Negative 47 million euro. But, and this is key, the balance sheet looks very healthy. They finished Q1 with 231 million euro in net cash.
All right, so a solid cash cushion there. Overall, management called it a solid start, despite the headwinds.
Yeah, that was the framing. A solid start in what they called a, quote, challenging market environment.
Okay, so that 4% revenue growth in a challenging market, how did they pull that off? Let's break that down.
It's interesting. Half of it, so 2%, actually came from acquisitions they did back in October last year.
Okay. So not purely organic then.
Not entirely. But the other 2% was organic volume growth spread across the group. So they were actually selling more stuff.
And what about pricing? Did that give them a boost?
Not in Q1, apparently. Management said pricing impact was neutral for the quarter. Any increases are really more of a Q2 story onwards.
Got it. And looking at profitability again, EBITDA was up too.
Yes, it increased. Went from 206 million euro last year up to 223 million this quarter.
And that feeds into maintaining that 16% EBIT margin. What did they say supported that?
Mostly stable pricing, like we just mentioned, and stable input costs. Those were the main drivers keeping the margins steady.
Okay, let's dig into the segments. Insulation seems to be doing a lot of the work here.
It grew 5% on revenue, and the big story there was North America. Really strong performance.
Offsetting weakness elsewhere.
Yeah, it offset a slowdown they saw in Eastern Europe, and they specifically mentioned Russia there. Oh, and acquisitions added 2% just to this insulation segment's growth, too.
Okay. The systems segment, though, that sounds a bit more mixed. What's in there again?
Right. It's a collection. Rockpanel, Lapinos OEM, Rockfont, and Cordeme horticulture.
In the performance?
Lapinos and Rockpanel grew. Rockfont was apparently stable, but Cordeme, that saw both revenue and profitability drop.
Any reason given?
Yeah, they linked it directly to lower sales in the legal cannabis market in North America.
Huh. That's specific.
Very. And unfortunately, they also said they don't expect that Cordeme situation to improve meaningfully in the short term.
Okay, that level of detail is useful. Shows how different markets impact them. Let's zoom out a bit to the regions. Western Europe.
Some good spots there. Growth in Germany, despite the market kind of waiting on new government programs. Switzerland, Spain, UK also did well.
Right.
But France was a challenge. They flagged price pressure there, especially in the professional flat roof applications segment.
Okay. Now the US, that 15% growth.
Yeah.
That really caught my eye.
It should. Very strong growth, 15%, and that's on top of what was already a high level from last year.
But there was a caveat, wasn't there?
Yes. Management layered in some caution, said some markets, some customers are kind of in a wait-and-see mode, holding back on orders for pipeline projects.
Why? What are they waiting for?
Clarity on the macro picture, interest rates, mortgages. The usual suspects right now.
So great growth number, but maybe some hesitation creeping into the pipeline execution.
That seems to be the message. And that Eastern Europe slowdown we mentioned earlier, they specifically called out Russia as the main area impacted.
Okay. So mixed performance now, but they're clearly investing for the future. What about those activities?
Acquisitions were 93 million euro in Q1, up a bit. But the big money is going into capacity.
Like what?
A whole new factory in Romania. Electrifying 2 lines in the Netherlands, which is a big deal for efficiency and ESG, and a very large factory project planned for the U.S.
And they're sticking to their full-year investment outlook.
Yep. Maintained at 450 million euro for the full year, significant spend.
And that strong net cash position we talked about makes that possible, even with negative free cash flow in Q1.
Exactly. The balance sheet gives them the room to make these big strategic moves.
Which brings us nicely to the full-year outlook. How are they balancing Q1 against all this uncertainty?
They're holding steady on guidance, still expecting low single-digit revenue growth for the full year.
And the margin.
Also maintained, right around that 16% EBIT margin level we saw in Q1.
Okay, holding the margin flat at 16% all year seems confident given the uncertainty. Is seasonality not a factor?
They addressed that. Said, yeah, there's some seasonality, but it's not significant enough to shift the needle when you weigh it against the macro question marks and the known hit from Eastern Europe, Russia. They did say they're adjusting capacity and activities locally where needed.
Makes sense. Let's get into some specifics from the Q&A. That systems division with the mixed results, what's the plan there?
They're definitely working on it. Talked about a catalog of improvements across the 5 different businesses in there.
Covering what?
Pretty much everything. Supply chain, production, pricing, even product rationalization. But they stress the challenges are different for each business, Rockfont tied to offices, Cordeme to horticulture. It's complex.
Got it. And there was a quick mention of Ukraine support.
Yes, another donation. Shareholders approved DKK 100 million more for the Sin Foundation at the AGM.
Okay. Capacity came up a lot. How much are they actually adding and when?
It's tough to gauge total market capacity because you have glass wool competitors too, but for their own stone wool, the additions are big. India is mid-2026, Romania early 2027, and that big U.S. factory is looking like late 2027, maybe early 2028. So still a few years out for the major impact.
Right. Going back to France and that price pressure.
Yeah.
How big a deal is that?
Management described it as tactical. Specific professional segments, flat roof, sandwich panels. They estimated the average impact around 1 percentage point in those areas, but stressed it really varies project by project.
Okay. Now, the U.S., again, that 15% growth, they were asked if it was just customers pulling orders forward.
Yes, and they were very clear. No, it was not pull forward.
But what is driving it then?
They put it down squarely to their market share gain strategy. Their U.S. share is tiny, like 2-3% versus over 10% in Canada. So huge room to grow.
And the strategy involves?
Multiple things. Getting new customers, using new channels. They mentioned the affiliated distributors group and really pushing product benefits like fire safety seems to be working.
So it's basically exploiting a big opportunity in an underpenetrated market for them.
That's the story. They see a healthy pipeline, but again, that wait-and-see hesitation is slowing down actual project starts. Dynamics haven't changed much early in Q2, but they do expect tougher Q2 comparisons because of volume shifts last year. And they are working on optimizing output from existing U.S. lines, too.
What about broader industry stuff, like consolidation in Europe?
It came up. Management agreed it's tough for smaller, single-plant stone wool guys. Scale, tech access, the cost of converting to electric melting, it's a lot.
So could that drive more consolidation?
They said while they weren't sure if it will accelerate, the idea that these difficulties could drive it is fair. No news on that Polish government asset sale they were asked about, though.
Okay. Pricing and costs heading into Q2. Any updates there?
Yep. Started rolling out 1-3% price hikes from April 1st in some areas, and a bigger one, 8%, planned for North America starting July 1st.
And costs?
Inputs generally stable. They've hedged about 70% of their electricity and gas for the year. And foundry coke, their biggest single cost, actually saw a small dip, maybe 1% quarter over quarter going into Q2.
Just to clarify, the Q1 organic growth, again, that 2%, that wasn't acquisitions, was that price or volume?
Almost entirely volume, they said. Just a tiny residual price effect from last year.
Okay. Regulatory tailwinds in Europe, fire safety, building performance, that feels like a big potential driver long term.
Absolutely. They highlighted a big focus on public affairs, working country by country on implementing the new EU directive, said meaningful programs are starting up, funding getting established in places like Romania, Poland, Germany, France.
So expect more news on that market by market.
Seems so. It's a gradual country-specific thing.
And that UK acquisition they made last year.
Performing well. They clarified it was a wall systems edicts business, not sandwich panels. Yeah. And they've fully converted its offering to stone wool, which they say UK customers really like.
Okay, final point on the guidance. Low single-digit organic growth for the year. Given the price hikes, especially that big US one, does that imply volumes aren't expected to grow much from here?
That's exactly what it implies, and management confirmed it. They said the guidance reflects that they don't expect large volume growth for the rest of the year.
Oh, yeah.
Pointing to the general slowdown, the hesitation they're seeing pretty much everywhere, plus the specific drag from Eastern Europe and Russia, they called the guidance realistic, not conservative.
Right. Okay, let's shift gears. Everything we've just discussed is based purely on the earnings call, transcript, and presentation.
Standard disclaimer applies.
This is absolutely not financial advice. But just as a thought experiment, based only on what management presented, if you were to craft an outrageous but plausible trade idea.
Okay, an interesting exercise, connecting the dots they laid out.
Exactly. So here's one. Go long AUL. Bet completely on the long-term structural story, overpowering any near-term noise.
And the rationale being?
That huge U.S. market share gap. 2-3% now versus 10% plus potential if they reach Canadian levels. Management has a strategy, new customers, channels, fire safety that delivered 15% growth this quarter without pull forward. That could be a growth engine for years, even decades.
And you layer on top of that the European regulatory push. Fire safety, energy efficiency, another potential long-term demand driver kicking in gradually across countries.
Precisely. And they have the balance sheet, the $231 million net cash to fund the big capacity investments needed to actually capture that demand when it comes.
Okay, so what makes it outrageous?
The outrageous part is that this trade idea completely ignores all the near-term problems management also talked about. The slowdown everywhere, the project delays, the Cordeme segment struggling, the Russia impact, and the fact their own guidance implies weak volumes for the rest of this year.
So you're betting that management navigates all that, maybe fixes or divests the weak spots, and that the sheer scale of the U.S. opportunity and the EU regulatory tailwinds eventually just overwhelm everything else.
But basically, yes. You need huge conviction in those long-term drivers. The trade might involve leverage, maybe long-dated options, to really capture the compounding if that thesis plays out over, say, 5 or 10 years. But again, pure speculation based on the call, not advice.
A useful way to frame the different forces at play, though.
So let's wrap up. Rockwool delivered what looks like a solid Q1. Revenue and margin met expectations, driven mainly by volume and recent acquisitions.
Yeah, despite what they clearly see as a challenging market backdrop.
Key takeaways for me were the strength in the U.S., really driven by that market share gain strategy, the ongoing focus on positioning for European regulatory tailwinds, and of course those significant investments in future capacity.
Balanced against the headwinds, though, the slowdowns, especially Eastern Europe, the specific issues in segments like horticulture, and that general wait-and-see attitude affecting projects.
And importantly, management maintained their full-year guidance. Low single-digit revenue growth, around 16% EBIT margin, signaling they expect that macro uncertainty to stick around and weigh on things, even after a decent Q1.
Just reinforcing, our discussion today is solely based on the information from the company's earnings call materials.
Absolutely not financial advice. Always, always do your own homework and talk to a qualified financial advisor before making any investment decisions.
We hope this deep dive helped you process the information from the Apple call and start forming your own views.
And maybe a final thought to leave you with, building on that trade idea.
Yeah.
How do you personally weigh those potentially massive, multi-decade tailwinds, U.S. share gain, EU regulations against the very real, very present near-term market volatility and slowdowns they're clearly experiencing right now? That feels like the core tension here.
Definitely something for investors to grapple with.